We are very happy to have with us one of the most influential researchers in empirical asset pricing and mutual funds, Robert Stambaugh from Wharton. He will give introductory remarks and sort of set the stage for today's topic. So Robert, I'll turn it over to you now. You have about 15 minutes.
Great, thank you, Lars. As Lars mentioned, the topic today is mutual funds, which is an incredibly broad area in finance, very heavily researched. If you do a Google Scholar search on mutual funds, you'll get either millions of hits or many thousand, depending on how finely you narrow the search. I think one of the reasons is because this is an area where we've had rather abundant data for a long time, particularly in terms of looking at professionally managed money. The mutual fund area has been the one area where we have much better data than other sectors of the professional money management. And there are really two topics that I thought I'd touch on today. It's hopeless to try to sort of give some broader perspective, I think, on mutual fund research because it's just so much of it. So I thought I would just use the two papers today, the topics that those papers take up, and just give you some of my thoughts, the things that these papers have sort of brought to my mind. First topic is on benchmarks and measuring performance, and the second is on fund flows and the relation to asset prices. So first on benchmarking, I guess we should sort of take as the objective here, or presume that we want to, in benchmarking, want to control for effects that are not reflecting managers' skills. Whether what you have left does reflect skill is a separate topic for debate elsewhere, right? Of course, there's one strand of literature that says, well, performance relative to some benchmark isn't going to tell you about skill either. But I think at the very least, whatever performance benchmark we construct, one objective we have for it is that it controls for things that I suspect we can all agree are not reflective of skill. And the controls here, there are a number. One of the first ones, of course, that we've talked about for many, many years is controlling for risk, right? If you're controlling for risk, you're not then allowing risk differences to affect performance. And it's somewhat related to that, but not necessarily the same as controlling for style, right? Because we think like, say a value style versus a growth style need not be a risk-based thing. It could be, but maybe not. And those are the kinds of things that traditionally we've controlled for. And then you can get into other sorts of controls that I think are maybe more controversial, but I think many would say are also things that we should try to allow for. Things like trading costs, for example, if you're evaluating a momentum fund and you want to benchmark it, if you simply use some before cost momentum return, I think we'd all agree that's probably not an apples to apples comparison, because momentum strategies in particular are somewhat costly to trade. And then there's an additional set of what this first paper called mandates and constraints, and here I've listed some that this paper mentions, things like constraints on liquidity of the fund. What's the universe of investments that it can undertake? What restrictions are there on short selling? Are there constraints on how much the fund can borrow, or how much cash it needs to have or not have? And also, things like turnover. And the first paper today sort of takes the approach that we can control for all these in a way that's sort of in a bespoke manner. That is, in some sense, it's almost a fund-specific benchmark that incorporates these various mandates and constraints, so that you do get more of an apples to apples comparison of the fund's performance to some benchmark. And what they find here, I think very interesting, is that when you do that, you generally get improved performance. And of course, this gets to the heart of a puzzle that's been around for many, many decades, going back to Mike Jensen and his '68 PhD dissertation. That when you look at the performance of funds, at least net of fees, net of all costs and fees, you get typically negative benchmark adjusted performance. And this has been a sort of repeated theme throughout many empirical studies over the years. And I think it's interesting that this paper says, well, if you do things a little more carefully in terms of controlling for these additional factors that that things change on that benchmark adjusted basis. This idea of mandate sort of brought to mind something that I'll call sort of the mushrooming mandate, and that's kind of this move towards sustainable investing that is taking account of environmental, social, and governance, so-called ESG criteria in investing. Yeah, we all know this has been very prominent in news lately. You know, BlackRock, the world's biggest money manager, sort of announced its adoption of ESG integration in its investing. You know, Morningstar actually called 2019 kind of a tipping point here. They noted that flows into sustainable U.S. mutual funds were actually 400% higher in 2019 than the previous year. And if you look at the total size of this activity, you know, over 2 years, you had by over a 1/3 increase in global assets that are managed in this sustainable fashion. And I think the question of benchmarking this stuff is just really in its infancy. You know, how do you do this? How do you benchmark sustainable investing? Because presumably there's a return, or a financial return component, as well as a sort of an ESG performance component. You know, how well does this fund achieve any kind of ESG goals or mandates? You know, one of the things that complicates this is that these mandates are often pretty imprecise. You know, how strong is the mandate? What weights are given to E, S, and G? And of course, that can be time varying. You know, for many years, I think E was the prominent aspect, the environmental part. I think this year has taught us that probably the social part of it's going to get much more importance. And the other complication, you get disagreement across stock ratings put out by, you know, a bunch of the major providers of this stuff that I've listed here. So I think this idea of trying to control for various aspects of investment mandates is only going to get more important as the sustainable investing grows. And this sort of brought up some questions in my mind about this whole idea of bespoke benchmarks, right? Because particularly when you think about this area of sustainable investing, you're going to get potentially many disparate bespoke benchmarks. In some sense, each fund is going to have its own, you know, tailored bespoke benchmark. And that means that, you know, if you're an investor thinking about choosing a fund, in some sense, you're choosing the mandate, or choosing the, you know, the benchmark that goes with that mandate, and you're choosing the fund sort of simultaneously. So I think the question, to what extent is this benchmark adjusted performance then going to be useful to investors, right? Because you may have, an investor might think, well, this fund didn't achieve benchmark adjusted performance as good as that fund, but I like this fund's mandate better, right? I like the benchmark that it's being compared to better. So it's almost as if there's going to be this sort of trade-off, right? The investors sort of simultaneously look at what is the mandate, and of course the accompanying benchmark, versus, you know, how well does the fund manager achieve that performance or that mandate. And so I think it's almost like a multi-dimensional choice problem where investors are going to simultaneously be evaluating the mandates as well as how well managers meet them. So you may well decide to go with a manager that performs poorly with respect to his mandate, but nevertheless has a much more attractive mandate than another manager that in some sense beat his bespoke benchmark. Yeah, I haven't thought deeply about these questions, but I think this paper and this whole idea of bespoke benchmarks to me raises kind of an interesting set of issues. I thought the other paper today talks about mutual fund flows, about which there's been a ton written, but very little of any linking mutual fund flows to asset pricing. I think that's sort of the novel take this paper brings. And just sort of to quickly summarize the idea here, so we can get the idea as to why there's this link. So in a given active manager, J's consumption is proportional to the fund's AUM, because the fee revenue is proportional to AUM, and the managers assume just to consume the fee revenue. And AUM can change either because of the fund's rate of return or because it gets money contributed or withdrawn, the flow. And this manager is risk averse, as it's averse to the variance in the change in AUM. So that's going to mean the manager is going to tend to want to underweight in the investment portfolio of the fund stocks that have high covariance of return with the funds flow, right? Because they want to basically lower the variance of the sum of the return and the flow contributions. And then the paper argues, well, there's a lot of commonality across funds in flows. So if we then look at the sort of aggregate flow number, you get an equilibrium result where stocks at high covariance with aggregate flow have low expected return, which is, I think, a sort of a novel link between flows and asset pricing. And they provide a bunch of supportive empirical evidence in that regard as well. Some questions that kind of arose when I thought about this is this a very efficient way to provide fee insurance? So if managers do worry about these fluctuations in their fee revenue, because after all, you think about what this is doing, what managers are tilting toward assets with lower expected returns and away from ones with higher expected returns due to this pricing effect. They're basically depressing the fund's return relative to what otherwise have been. But most of the fund's return goes to investors, right? So the fee rate is only taking a small chunk of that return effect. So is this really efficient for investors who are basically getting most of the return to be bearing the cost of providing this insurance to managers? And I also wonder about what's the incidence of this risk on managers, because many mutual fund companies, for example, are either there's a large group of funds owned privately, like Fidelity by the Johnson family, or T. Rowe Price, publicly traded. So ultimately, in the end, who is bearing the risk and the revenue? Is it really the portfolio managers? Is their compensation so tightly linked to the fee revenue of the fund company, or is there sort of a lot of risk bearing happening elsewhere? But to the extent that there is a lot of risk bearing directly being done by portfolio managers, I would think this is actually probably stronger for hedge funds, right? So you've got hedge fund managers. First of all, they're charging incentive fees, so their fee revenue is more heavily linked toward the return, and also they generally have a much bigger equity stake in the fee revenue directly. So if there is this hedging motive among fund portfolio managers, I would think the place you might like to see it more strongly is among hedge funds, as opposed to, say, large fund companies, diversified fund companies. One thing that this sort of harkened back to for me was this relation between flows and returns. I'd seen before in a paper by Akbas, Armstrong, Serescu, and Subramaniam in JFE that sort of looked at flows in relation to how they relate to mispricing. So they looked at a composite mispricing measure. This is actually a measure that I'd used with Jianfeng Yu and Yu Yuan in some earlier work, where they rank stocks on this composite measure, form long and short leg portfolios, and look at the returns on these things. And what they found is if you regress these returns on contemporaneous mutual fund flows, an aggregate fund flow number, you actually get a pretty significant effect. In fact, you get in particular that the overpriced stocks, would be the short leg stocks, have significantly positive aggregate flow betas. The underpriced negative, but not very significant. So if you think about what sort of stocks funds would be tilting away from, well, you would hope they're tilting away from overpriced stocks in addition to stocks that might have a high flow beta. So if empirically we see funds tilting away from these stocks, the question is, okay, why are they doing it? Are they doing it because they don't like their flow betas due to risk hedging considerations, or are they tilting away from them because they're overpriced? And the other interesting dimension of that study was that they found, if you look at the lag flow, look at the return regressed on lag flow, the signs actually flip, right? So if you're thinking about flow betas, it seems like the world is not sort of IID, right? There seems to be this interesting lead lag relation. These are just more or less random thoughts I had in response to both of these papers. And since I don't want to overstep my time limit here, I will turn things back, and we'll hear from Michael.